Hi everyone. Welcome back. Now, question number 16. Question number 16 is to determine whether the current price of the common stock is aligned with its intrinsic value. An analyst want to use Gordon growth model, and to appropriately apply the model, the analyst will need to estimate what. So this is the question which involves theory. So your theoretical knowledge will be checked or tested here. So determine to determine whether the current price. So the current price, and then we have this we are talking about a stock, not bonds, is aligned with its intrinsic value. If it's aligned with its intrinsic value, so what does this means? The analysts want to use Gordon growth model, and the formula for Gordon growth model is V0 is D bar dividend next year, cost of equity, we subtract the growth constant. This is constant growth. And when the growth is fluctuating, and when we discussed about the multi-stage dividend model, we talked about when the growth changes. So how do we solve what the question is testing here? And let's first check our options here. So a fluctuating growth rate assigned to dividends, yes. A growth rate that is above the required return and the dividend to be received next year. And to estimate this, what does the question is testing here? These are our three options. So understand the Gordon growth model is also known as constant growth dividend discount model. So here the growth is actually constant. So we will be using Gordon growth dividend discount model, simple dividend discount model, TDM, not uh, multi-stage DDM. And this takes the next period's dividend and divide it by the difference between the required return, this is required return, and growth rate. So the growth rate is assumed to be a constant here, and it must be below the required rate. And if it's not below the required rate, this becomes a negative value and doesn't make sense. So this means that you are growing at a rate of 10%, but the required return is 11%. So this doesn't make sense. This gives you a negative value and you do not want that. So the constant, this is what the growth rate actually assumes to be constant, and uh, it must be below the required rate, or else the denominator in the calculation will be a negative and making this invalid. So you need to understand the technicality here. So now let's get back to the question to determine whether the current price, this is what we actually have to determine, which is aligned with its intrinsic value. The analysts want to use Gordon growth model. To appropriately apply, the analyst will need to estimate what? A fluctuating growth rate assigned to dividend. This is for multi-dividend model, multi-stage dividend model. A growth rate that is above the required rate. So if the growth rate is above the required rate, this becomes a negative value. Uh, that we do not want. And the dividend to be received next year, yes, we want this. This is the only condition. This is only the right answer as per the correct answer as per the situation. Not so understand the context of context of the question, what the question is asking. I hope this is clear. Now let's go to question number 2. This is company Abeta's stock. is trading at $47 and Beta just paid a dividend of 1.5. The market assumes a constant rate in dividend. This is the constant rate in dividend, GC, growing at a constant rate. The company just paid the dividend. So this is D1. And this is the stocks. This is actually what the stock is trading at. This is actually the price, not the dividend, understand? So basically the formula is price is actually dividend next year dividend divided by cost of equity subtract growth constant. This is what this means. Now understand. This means when we plug in the numbers in our equation here, next year dividend, they just paid dividend 1.5. Now cost, we do not have cost. The EBITDA's required return of equity, we actually have to calculate this number, this variable, and the growth constant dividend of 4%. And when I say 4%, always convert this into appropriate form and never forget the percentage sign. So constant growth rate. EBITDA's required return on equity is closest to what? Now this is dividend D0. Okay, I forgot that. I just forgot this. D0. They just paid dividend D0, not D1. D0. So what you need to do here is you actually need to calculate, you need to multiply it with 4%. So I'm going to just put 0.04. This will calculate our value. And okay, let me just calculate this value quickly on my calculator and we will be also able to see. Yeah. Okay, let me just minimize this. Okay. So first we are going to plug in 47. Okay, 1.5 is we multiplied with 1.04. We divide it by 47. This is going to give us 0.03. Now we subtract the cost of equity. Okay, we add it back 0.04. This is going to give us 0.07. We multiply this with 100 and this is going to give us 7.32. One thing I missed here, I did not rearrange the formula. So this is going to be KE minus 4%, 0.04. We 1.5 into 1.04 divided by 47. And at the end, when we actually have to calculate cost of equity, 1.5 into 1.04 divided by 47. We add back 0.04 here. Okay, so now let's go to question number 7. Question number 7 is the bond pays annual coupon interest of 6%, 6 pounds, 60 pounds, my bad. This is the coupon payment and face value is 1,000. In 7 years, this is your time. The bonds price today is 1045. Its yield to maturity is closest to what? So this actually is a question from bonds, and let's anyways do this. No issues. I think I have added this here. For, okay, let's no problem. We will discuss since we are discussing about equity and the LOS is interpret the implied return of fixed income instrument and required return of implied growth of equity and as well as fixed income. So let's do this anyway, no problem. Uh, the bond pays annual coupon of 60. So here the N is 7. Here the time is 7. That's what it is. Face value. Face value means future value is going to be 1,000. The coupon payment is your PMT. It's going to be it's going to be 60 pounds. Present value is how much? 1045. Now remember this thing. There are two approaches. Either you say that 1045 is a negative number. You consider present value as an outflow. So now you are paying, and here you are receiving something. Or you can do what you can do one thing. You can say that here this is the present value if you are in a bank or an investor. So here you are saying that this is a inflow for you. Here you are receiving, and these values you are paying back to the investor. So totally different assumptions, but the flow, just understand the flow of the signs. uh, Either way you will get the similar answer. Receiving, okay, let me just fix the spelling. And here you are actually paying back to the investor. So you are actually paying back to the investor. So once you plug in all these numbers, you will calculate what its maturity, yield to maturity. It's I slash Y. You need to calculate its I slash Y. Let me just share my screen quickly. Uh, Clear screen. Let me just refresh it for better. Uh, this is our future value. This is our future value, and the present value is okay. Let's just plug in coupon first. 60 is the PMT. 7 is the N. I slash Y we actually have to calculate, and before that, just understand that I will be plugging 1045 as a negative number. Uh, this is the present value. Now compute I slash Y. 5.22 is the I slash Y. Let me just clear my screen and let's go back to the previous window. So 5.2 is our option here. Question number 28. So question number 28 is again from fixed income securities. So a 5-year 8% coupon bond with a par value of 1,000 pays interest annually. The price is 142.5 and the yield to maturity is 9.5. So I slash Y it's given here 9.5. Price is the present value, it's 942.5. Time here is 5 years. 8% coupon bond, 8% of 1,000. The coupon is 8% of 1,000. It's going to be 80. The yield to maturity is going to be closest to what? The yield to mature. Okay, the price is 942 and the yield to maturity is 9.5. If the bond's price moves to 963, now if the present value moves to 963.75, what would be the yield to maturity of the bond? Now here, this is the future value. And always remember to use sign conventions. 9.5, 942, 5. Coupon payment is 80. So PMT and present value. These must have different signs. Either you are saying this is an inflow and this is an outflow. So you are paying something and you are receiving something. Or you can say this is an this is actually and also this is an outflow. If this is an outflow, this will also be an outflow. So just remember that future value and payments are going to be there will be same signs for this, and for cash outflows there are going to be different signs. Just use the sign convention properly. I'm saying now let's plug in these numbers here. Calculator screen again. So 1000 is our present value, or not present value, the face value. The future value is going to be 1000. 5 is going to be n. Payment is 80% of 8% of 8% of $1,000 is 80. This is a PMT. Now the 963.75. This is in cash outflow, and this is going to be your present value here. Now I'm going to compute the I slash y. So I slash y is going to be 8.63. And we have 8. It was 8. The answer is 8.93 basically. Maybe we miscalculated it. I miscalculated it. 8.93 is going to be the answer. Maybe I misread it. Let me just check it again. I'm okay. Let me just share it one more time. This should not be the issue. So it should be the exact value, not 8.55. So I would not have calculated it one more time if I would have been sure that this is not the case. 1000 is the FA, PMT is 80, and the present value is 942.5. Negative number. So this is the present value. N is 5. Compute I slash Y. Oh, 9 point. What did 108963.75, a negative number is I private is PV. N is how much? 5 years is N, and compute I slash Y 8.93. Okay, 8.93 is the right answer, and I maybe misread it. So 8.93. The option is 8.93, and always now understand this thing. The calculator will give you the exact value based on the numbers you have plugged in. Let me just show you. If you did not understood the question properly, and if you used 942.5 942.5 as a negative number for the present value, and you computed I slash R, uh, mm, okay, I need to refresh everything. So 1000 is the future value, PMT is 80, present value is 900. If I would have 942.5 as a negative number, if I would have plugged in present value here, and N is 5, compute I slash Y, this is going to be 9.5, and this is going to give us incorrect value. So Since that is not here, so based on this information, if we would have used 942.5, we would have done the incorrect. We would have chose the wrong answer here. Okay, so now question number 36. So question number 36 is again from fixed income securities. The question number 36 is investor spends $365,000 uh, purchasing zero coupon bonds. So no payments here, no PMT. The total face value of this is the face value. This is N for the annualized rate of return above 3.2. Now, if you understand the question here, so N is going to be 10 years. We need to calculate for the annualized rate of above 3.2%, the bond's price will have to be what? This is the present value. Okay, present value and future value. So 365 you paid for it, and in future you are going to receive 500. The rate you actually have to calculate. N is there, 10 years, and PMT is going to be 0. So once you plug in all these numbers, just be cautious that if these are positive numbers, this is a positive number, present value, so just plug in these numbers as negative. And if you say that future value is a positive number, then plug in present value as a negative number with a sign, negative sign. Okay. Question number 30. So now let's assume that 1 and 2 year risk-free rates are 1.8 and 2.5. These are two risk-free rates. And using the cash flow additivity principle, the 1 year reinvestment rate 1 year from now would be closest to what? Okay, this is the question from next reading. The next LOS. So we will discuss about this question there. So that's it for today. So I'll wrap it this session quickly, and in the next session we will start with LOS. The next LOS. Okay, thank you for attending the session.